Hi there, and welcome to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. This week, I'm talking with Matt Kaufman, who's the head of ETFs at Calamos. Matt, great to have you on the show.
Sumit, thanks for having me. Appreciate it.
Absolutely. So, Matt, you recently launched a suite of ETFs that offer investors 100% downside protection. How are these ETFs able to offer 100% downside protection? I'm assuming there's no free lunch, right? So, what does an investor give up to get that left tail protection?
Yeah, thanks, Sumit. It's not just a marketing headline. These ETFs are in fact designed to deliver 100% protection over a 1-year outcome period with the upside potential to a cap. So there's capped upside potential. So there's your no free lunch. And it's relative to one of three indexes: the S&P 500, the NASDAQ 100, and we're also on file with the Russell 2000. So on May 1st, we launched CPSM, which was the S&P 500 version. The adoption was phenomenal. We saw around $100 million come in around the first week. We just launched CPNJ, the NASDAQ version, on June 3rd. We saw similar adoption. In fact, the volume on CPNJ was larger than we saw on CPSM. We had about 1.7 million shares trade just in the first day. So it was a phenomenal adoption. On CPNJ, you get that upside to a cap. And so the cap rate that we struck on that particular product was around 10.2%. It was precisely 10.2%. So investors buying in at the beginning can get the upside of the NASDAQ 100 to 10.2% over a 1-year outcome period with 100% protection over that time frame. You don't just have to buy in at the beginning. People are still buying in. You can buy into these ETFs all along the outcome period. Any day the market's open, you can buy and sell it just like any other ETF. And so you'll have your own payoff profile when you do that. So if you go to our website, calamos.com, you can click on the ETF ticker, and it will show you, if you bought today, how much upside potential you have, how much downside protection you have, and then how many days are left in that outcome period.
And it sounds like you have these ETFs tied to some very popular stock indexes, Matt. Is it just limited to equities, or do you have products that are tied to other asset classes like fixed income?
Yeah, so these are all built and tied to equity markets, and they're built using flex options positions. So we can customize strike prices, expiration dates, and style. So we really look to do this on very liquid, broad underlying indexes. We've started with these three. We've also filed for a Bitcoin type strategy, which we know options need to exist and then be liquid in that space. So it's something that we're on file for. But again, you can tie this to a lot of liquid markets that also have options tied to them. But right now, we're just doing it on the three broad equity indexes.
Matt, when a lot of people hear about upside caps and downside protection, they think about buffer ETFs. How are your funds different than buffer ETFs?
Yeah, if you follow the structured note space or the annuity space, even maybe the banking space for some CDs, the buffered products give you partial principal protection. And so those are great strategies. Those work very well for those looking for partial, principal protection or a buffer. And when we were in that low rate environment post financial crisis, that was a trade that was working very well back then. In a very low rate environment, post financial crisis, we went down to 0 basis points, maybe 50 basis points. We were kind of floating around there. When you're in that type of environment, what we saw are insurance products moving to this risk sharing model, where instead of principal protection, which you couldn't really deliver in that low rate environment, you would deliver something less. You would deliver a buffer on the market, maybe 10% protection or 20% protection. And then you could deliver meaningful upside relative to an index. So we saw that buffer ETF space grow. It grew in the UIT marketplace. All the registered investment companies were using this type of intellectual property to deliver a buffer and a cap on the market. As rates have gone higher, and we saw that rate lift off in 2022, we can now afford to deliver capital protection or 100% protection on an equity index. And so that's the space that Calamos is looking to capture. It's a different type of space, and you follow notes or annuities. You've got buffers, you've got income type products, you've got auto callable type products, and then you also have this capital protected space. That capital protected space is about 4 times the size of the buffer space across insurance and across the bank note strategies.
So I'm curious, who's buying these products, Matt? Is it financial advisors?
Well, our clients are financial advisors at Calamos. We build products that are used by the financial advisor. And so, those are really the folks that we support on a daily basis. Right now we're seeing a large majority of registered investment advisors or RIAs utilizing target outcome type ETFs and capital protected ETFs. And so those are the folks that we're talking to on a daily basis. We've seen a large influx of money come from financial advisors who are putting their clients' money to work. And they're doing it roughly in one of two ways. The first would be to tie their cash or link their cash to the equity markets. And so if you think about, a lot of folks buying CDs today, they're buying fixed index annuities, which gives you 100% protection, over a term. And so people might, say, I want that 5% interest rate that the CD is going to give me. Well, in a year, that CD is going to expire and you're going to pay ordinary income rates on that. So if you're in the highest tax bracket, your 5% might turn into maybe 3% after taxes. So CPSM or CPNJ gives you that opportunity to tie, instead of taking your 3% after taxes, you can tie your cash to the equity market, get upwards of, 10% upside cap relative to one of those markets. And then you can earn that money tax deferred. The money stays in the ETF and it grows and compounds tax deferred. And then when you sell, if you've held the ETF for longer than 1 year, you're paying long-term capital gains rates. So we see a lot of money moving in for those reasons, tax efficiency and tying cash to the equity markets. The other side of that coin would be people de-risking their equity exposure. And so we see folks who maybe ridden the markets up toward all-time highs. The NASDAQ is near its all-time high. And so we see folks de-risking their equity exposure by just moving a portion of their equities into this type of strategy. So, let's say, Sumit, if you want to take half of your equity risk off the table, over the next 12 months, you might move 50% of your money into CPNJ. And so now you have 50% downside exposure instead of 100% downside exposure, 50. And then your 0 to 10.2% upside, you're still capturing 100% of that upside at the portfolio level. And then instead of being, hard capped out, you're going to capture 50% of all of those gains after that 10.2 in your portfolio. So we see folks using it that way as well. And then if I could add a third, option here, we see a lot of retirees using this for providing for themselves when they no longer work. We're seeing roughly 11,000 people per day entering retirement over the next several years. It's the largest swath of retirees that we've seen in American history. It's a massive amount of people. The baby boomers are all moving into retirement. And so those folks have got to outpace inflation as they start to spend down their portfolio. So the risks that a lot of retirees face are largely financial. It's longevity risk, the risk of outliving your portfolio. There's inflation risk. There's volatility risk. And so the structured protection ETFs that Calamos has built can really help to solve all three of those problems in one ETF. And retirees can now outpace inflation, tie their money to the equity market in a safer way. And we see a lot of folks using it that way too.
Matt, these products obviously sound very compelling. What do investors need to do to ensure that they get that full 100% protection? Is it about investing on day one or the first few days, or do they have to watch the net asset value? What do they have to do?
You can do either. If you get in toward the beginning, getting in at the net asset value at that beginning price will give you that full protection level. Even if you get in, a little bit after, if the market has come up a little bit, you may still have 99% protection or something extremely significant. For CPNJ, today's June 4th, I'm recording this, the NASDAQ has fallen a little bit since the product came out. And so the NAV is down slightly. So you'll be able to still get that 100% protection level. So I'd say anytime that the ETF price is around where it started is an opportunity to get 100% protection over the remaining outcome period. Or if the market's down, that's another great opportunity in our view to get in. But we see people buying in all along the way. So for CPSM, the S&P 500 has risen a few percent. And so if you bought CPSM, right now you would have about a 98% protection level, still very significant, and about 8% of upside cap remaining. Or to say that inversely, you'd have about a 2% floor, you get 2% at risk there before your hard protection level kicks in. So we see people buying in all along the way. And again, we would encourage people to use the website charts to see exactly what those parameters are. And you can know all of that before you even invest your money. You can know how much upside potential you have, how much cap you have, and how much protection level is remaining, and then how many days are left. So 3 very simple metrics that you can know before you actually invest money.
Fantastic. Well, a ton of great information, Matt. Thanks so much for your time.
Thank you.